Plains Angels is an initiative of the Greater Des Moines Partnership that connects Iowa-based angel investors with early-stage growth companies throughout the Midwest.
Chris and JD, come on up. We promise you a break after this one.
Just off of that, the data room due diligence, I think that one of the common themes, hopefully you've heard, whether it be the 10-page slide deck, or one-page, or your financials, whatever, is be organized, appear organized. It makes a huge difference. Don't make an investor have to go to your Dropbox file or wherever and try to search for stuff or have everything's just, I've got on some of them and there's 28, 30 documents down there and you don't know what they named them and all of that. Put things in folders and everything, but it's really about appearance as well. And if you appear to be well organized, well structured, it makes a heck of a difference to an investor during their diligence process. We're going to cover the term sheet, kind of at the high level. We've had a lot of discussions about the term sheet already today. I'm going to cover some of the economic side, the pricing side. Chris Sackett's going to cover some of the governance and the control side. I think somebody even asked what it was. I mean, basically it's the document that outlines the terms at which an investor, whoever it be, angel, venture capital, will make a financial investment in your company. Sometimes the companies will put out an initial term sheet. Generally what we're talking about now is really more of the structured term sheet that you might get from a potential investor and or angel group. What does it include? There's financial terms, amounts raised, the pricing, the valuation, some of the preferences and rights that the investors are wanting, whether it be dividends, liquidation, anti-dilution. We'll get into some of these as well. And then some of the control issues. How are you going to be governed? Board seats, voting approval rights, informational rights, etc. So valuation and pricing. I'm going to assume that most of you probably understand these terms, but we're going to walk through them. Pre-money valuation is just what you say your company's worth today before you take in an additional investment. So it's just that simple. This is what I'm worth today before anybody writes me a check into this round. Post money is the value after. So basically, post money is in the investment after the investment equals basically the sum of the pre-money plus the new money that came in as your post money value. So I'm going to walk through a real simple scenario. So let's say we are going to raise $1 million. And we're going to set our pre-money at $2 million. So the real quick math is, again, I never really necessarily worry about this number, the price per share, until I have to start to calculate the number of shares we're going to issue in the round. So my pre-money's 2, I'm going to raise $1 million in this round, my post-money's 3. And this just shows you as well is I basically have $2 million at a pre-money, and there happens to be 1 million shares outstanding. So that's how I calculated the $2 per share. So then if I'm raising $1 million, it's as simple as the company is now issuing an additional 500,000 shares, which is the 1 million divided by the 2. This number could be whatever's outstanding for the company. There's nothing magical about that million. You could have 100 shares outstanding and or units. But the equation is just driven off of that. Obviously my post money is 3 million. My total shares now are 1.5 million, which ironically equals $2 a share. Okay, so let's just do two methods of calculation. My pre-money was 2. This is my ownership right now. This is ritual founders and early investors maybe at the $2 million. Now, basically, we got a post of 3 representing 66%. Again, the original ownership had 1 million shares already. There's 1.5 out. They got 66%. The new money coming in, basically, they put 1 million in at a post of 3. They own 33%, and they have 500,000 shares. Post of 1.5 million shares, they own 33%. It's just different ways to look at the ownership on a pre and post. And again, we could spend 2 hours on some of this stuff and some of the ramifications. some of the items with regard to some preferences on the economic side is liquidation preference. And what that means is it's a preferred preference that basically they have the right to get their money out ahead of any other common shareholders. Sometimes you'll see a preference of 1 times, 2 times, I've even seen them 3 times, where basically they have, if there's a liquidity event, you sell, you merge, unfortunately you go bankrupt, they have a return right of whatever that formulation is and whatever that preference is to get whatever their initial investment times 2x, 3x, or maybe it's just 1x before any common shareholders or even probably any of the prior rounds can get to their funds.
Do you always see 1, 2, 3x, or do you see every dollar figures?
Sometimes you'll see it in price per share. I'll show you that, and Chris can add some stuff on that too. But sometimes you see it 1.2. I mean, 1. It just depends, right? But basically, what they're saying is if a liquidating event occurs, we're going to get our money plus an additional kicker out. So let's go through some quick math here. Again, that basically we had a $2 million pre, we had $2 a share. The new money came in at $1 million at $2 a share. I got 500,000 shares, but I have a 2x preference. So it's simple math, meaning is I buy it at 2, but I've got $4 a share preference. I get $4 per share out if there happens to be a liquidating event. So let's just say it's a good thing. This isn't completely a washout, but let's just say we merge, we sell the business for $4 million. I'm the investor. I own 33% of the company, but guess what? I get $4 per share out of mine first, so I get $2 million, or I get 50% of the sales price by only owning 33%. And that can be a lot more onerous depending on the value of what you end up selling it, whatever the preference number is. So, real generic example, but it just shows you some of the terms that could be asked for, that they do mean something, particularly if you're, one thing it could be you're in a hot market, right? And you could take an exit in, a short order, 24, 36 months. You got to understand what maybe these shareholders or whatever this preferred terms are they're coming in on a liquidation preference.
JD, I might just please comment, because just in the last couple of weeks I've had a conversation on that issue. It was a two times preference. The valuation of the company is substantially higher than the time when the preferred money came in. So it looks like a bigger number, looks like a pretty good deal, but this is the point at which the common shareholder is saying, whoa, wait a minute, that sale price, well, it seems like a really nice price, that common shareholder is going to get less at that higher valuation than would have gotten before that because of the 2 times preference. So that's what I was talking about earlier. You have to run the waterfalls, run the scenarios, and figure out when does that become an okay thing and when is that maybe not. It's not that the concept of a 2 times or a 1.2 times or a preference, it's not the concept itself that's bad. It's how does it work through the math?
That's exactly right. And for some reason we don't have much on dividends on this as well, but it's kind of the same type of thing. Sometimes you'll have a dividend calculation, you're accruing but not paying the dividends or the preferred, and all of a sudden something happens and you've got 3, 4, 5 years worth of dividends that could be on preferred stock as well. I apologize, that's not on these slides, but I guess the important thing is albeit one small paragraph in a term sheet, it could change your life. So it's very important to understand that. We talked a little bit about options.
Can you go back?
Yeah.
Really quick. So once the preference has been satisfied, what do they get beyond that?
Well, that's a great question, because sometimes then they have rights that they proratically share in everything else as well, and sometimes it's a little different. I don't know, Chris, if you have any opinions on that, but again, it's all based upon the terms of how it's structured in there, but usually then they can that might be just their exit, right, and then the rest is going back to the shareholders. I know that there's other levels where then they also have rights with regard to the other side.
If people have ever heard of participating preferred with a preference, so that's kind of the preference, and then they participate on a pro rata basis with the commons. And so again, to see just a few words, and all of a sudden, well, wait a minute. So they got a 2 times, it wouldn't happen very often around here, but a 2 times preference plus their pro rata share of the converted, and all of a sudden it looks a lot different. The math is a whole lot different, so you have to read that carefully.
Just a question on this in terms of coming up with a new way of slicing the cake essentially, and for somebody who's coming in at a later round, and I'm wondering about that previous round in your example, it was the founder, so maybe they contractually can change the terms of the contract to suit this new group of investors. Let's say you have another party between those two who, gee, I thought I had agreed to get a third of this company, and now all of a sudden you're giving away to somebody else who's come after me. Do I have to, if I'm that previous party, have something in the term that basically says I'm not going to allow you to slice the cake another way? I mean, how do you, this is, it seems like it's a post-contract.
This is really primarily driven institutionally, and this would be maybe in a later stage round, but we've seen them early stage come in as well, like we were talking about that put option, which was an early stage thing. I'll answer, like Chris answered. A lot of times, if, let's say this is $1 million raise, right? I mean, it could be much more substantial. A lot of times, if the company is needing those funds, and it's a situation where there's great opportunity for success, people negotiate terms away sometimes from earlier rounds, and sometimes the shareholders will appease that because they want to, obviously, whatever. Somebody made some comment about 90% times zero value versus 10. It's all about trying to create value. So everything's always negotiable, but it's problematic. There's no question. I don't know if that's answering you, but
I'm just wondering, did these other people, these previous people, have any contractual rights to?
Sometimes they
in this
do.
case, say, well, I'm happy to go along with this preference.
Sometimes they'll have, with regard to the shareholder agreement, approval rights, and they don't. I mean, they don't have to necessarily forfeit any of their preferences that they currently have. I don't know.
Yeah, when I get up there in just a little bit, I'll talk about kind of protective provisions and what they have.
And that's what I.
A lot of times, the people that are later on arguing about it had a vote on it before and approved it.
There's a lot of different ways this gets sliced. This is really kind of a rudimentary way to look at it, but it tells the story, right? It's basically telling you that not everything is just dollar for dollar in any type of liquidation, whatever yet.
So, JD, when you're advising entrepreneurs on this, how do you think that they ask enough questions, or do they really leave understanding all these terms? Or
Probably not. Probably not. And really, probably within the first 5 minutes of any meeting I have with someone, is I always ask who their counsel is. And seriously, I mean, at that point, I'm not an attorney. And it is very important that whatever you're going to execute, that you do understand, and and if you don't, you have somebody to help you work your way through it. But also to catch things that a layman like myself won't catch as well. So, but do they understand it? No. And and to the point is, the more sophisticated the investors, generally, meaning maybe it's a VC or institutional investor, generally it's the more onerous they are in terms and their requirements. But we've seen it. The put option that we talked about that was on an early stage round came from a small institutional investor that demanded it to come in to this, and that person that fund put $150,000 in, but they wanted that put right, and it drove the rest of those terms, but so it can happen, and you just got to go. I think if anything coming out of this is just understanding it's not just as simple as saying, I'm going to put $500,000 in your company for 20%. It's everything else underneath it, right? So, okay. High level stock option. Basically what it is, it's and then I'm primarily focused on employee stock options here. There's qualified, non-qualified for another day. But really what it is, it's a carve out of equity. A pool is created, it's a carve out of equity for the employees to have the right to buy at today's dollars in the future your stock. So they're able to go on the ride, and generally they're going to invest over time. I might hire Spencer today, and I'm going to give him I'm going to grant him so many options today, priced at today's dollars, but he might vest in those a third over 3 years' time, meaning that if he leaves during any of that time, he doesn't invest. A lot of times if something happens, we sell the company or something like that, there's an accelerated vesting. But it basically is a way to get your employees to participate in the upside. The logic behind it is, one, not only from a compensation perspective, but to get their buy-in, to get that they feel part of ownership, and everybody is driven toward value creation in the company. So what's an option pool? It's basically a pool of shares that haven't necessarily been allocated anymore, set aside. So we talked about a cap table earlier, right? And you'll hear the term fully diluted cap table. A fully diluted cap table means is I want to look at the picture today on everything that could possibly happen today. So I'm going to look at the cap table, and it should include on a fully diluted basis option pools, whether they've been granted or non-granted, because this is the potential dilution that I as a shareholder could be impacted by. So just a basic number is about 10% of the outstanding shares. And again, it just seems to be a good metric. Basically, you say, okay, I've got, X amount of shares outstanding. I'm going to carve an additional 10% out and set it aside for employees. Again, the employees granted a certain amount of shares that vest over a period of time, price of today's share price. The important thing on this as well is, if I'm going to put $1 million or $5 million into your company, Spencer, what I'm going to tell you to do is before I write you that check, you create the option pool. You include that all in the price. You guys take all that dilution, then whatever that calculation comes out, then I'll step in and acquire the shares. I'm not going to allow you to have me come in and then create the pool. So a lot of times, particularly, actually smart VCs, institutional investors want the employees incentivized, so they're going to want an option pool. They're just going to want you to carve it out and do it before they put their money in, so they're not being impacted by the dilution.
Does that go the other way? Excuse me. Does that go the other way? So employees that are granted the options up front, then when there's an investment later on, does that dilution go back on the
It does.
options that they have?
It does, and that's a great question. So generally, like let's say whatever the round was going to be, we might initially carve out a 12.5% pool because we know post it's going to average about 10% or something like, it's a circular formula, right? But there's no question that the total ownership percentages would be impacted by whatever new additional rounds, et cetera. Your price isn't going to change though, right? You still have, if you're worth a buck a share today out on a fully diluted basis, it's calculated, and you sell at $5 a share, you're getting the difference. You have the right to buy it at $1. You're basically, and normally on an employee, it's a capital, it's just treated as a capital gain on the appreciable value of that. But yeah, you share dilution.
So what happens when you combine your option pool that was created when your company was started with your liquidation preference that you were talking about before? Now the employee option pool is common that it is worth nothing.
Yeah, well, if it's worth nothing, it's worth nothing, but that's to your point. It would be part of that whole calculation and distribution on a pro rata basis.
Is there ever option pools that allow preferential treatment? Is there cases where we put option pools in preferred stock?
No, but I've just done one recently where we basically did an agreement where I can't remember what the exact term was, Chris might not, it was basically a management carve-out. We set aside $3 million, but management gets the first $3 million out of any exit, which is totally, it was basically an incentive plan. I don't know of any option pools, Chris, to get incentive. Most of them are common share based, yeah. So.
I see what you just talked about, sometimes called a TIP.
That's
Like
exactly.
a transaction incentive plan. And when you're running a waterfall, you got to know about the tip too, because it's kind of like that Jenga game, right? You pull one out of here, and all of a sudden things fall down. It's strange, but I've never seen preferences at the option level.
But there's no reason you couldn't issue an option to purchase preferred shares if you've established them. There's no legal reason you couldn't.
Right. Generally, they're just common shares, and it's just. I will say, and I'm no tax expert, so I don't really grab one of my tax partners every time we start talking about LLCs, but options on LLCs are a lot more complicated. And, there's profits, interests, and, all this kind of stuff. These guys can talk a little bit about that, but a long story short, there's ways that if you have an LLC and you issue basically options or give basically interest, that then you lose they basically become members as well, and they're no longer W-2 employees. And they get basically through distributions, got to do holdings and stuff. There's a lot of complexity there, but we'll let the tax class be out of everything. But there is some. It does matter how you're corporately structured. And then just I think finally, from the board and government side, we talked a little bit about terms and stuff. You know, new money means new bosses. A lot of times in the term sheet, if a board doesn't exist, particularly if you're early stage and it's money coming in, you know, the term sheet might even call for the establishment of the board. Generally, you always want a board that's an odd number, just for obvious reasons. I'm not a big 7 board seat guy, I'm more of a 5 board seat guy. But sometimes in the round, they'll you know, want 1 or 2 seats, and sometimes more, and sometimes you want observer rights. You know, it's just another term that's negotiable. And then, like, you know, Chris will get into some of the other control issues, but it's just one more thing. When you get that outside money, and particularly when it's not friends and family you're accountable to, but then you've got a whole other layer of governance as well. I think this is you, it's me, Mr. Sackey. And we'll be able to answer questions after Chris wraps up too.
Yes. Both Ben and Matt mentioned that they were having challenges in raising funds over the valuation. And then it said it's more of an art. Are you able to touch on what components? I mean, obviously money you've spent, other things, but what goes into that art? Are you able to summarize that quickly?
It is much more than an art than a science. I mean, I've had people come to my office that, you know, are looking to invest in something, and they want the actual appraisal report why this company's worth this, and that you really are an early stage company, it doesn't exist.
Yeah.
But, you know, it really is understanding what the market opportunity is, you know, what possible exits in the industry have been. I mean, it's a very subjective process. But again, also, you've got to be a good listener as well, look at what the market's telling you as well, if you're asking for, you know, with regard to valuation. But we have usually a pretty good thumb in the air about approximate, you know, particularly early stage, if you're pre-revenue, if you're post-revenue, if you've got customers, you know, if you're over $1 million in revenue, there's a lot of other things that you look at to qualify that, but it's a very subjective process, and generally, a lot of times the lead investor sets that term, right, sets that valuation, that's what you're chasing that.
There's some good articles. I don't know if they're members only, because I'm a member, but the Angel Capital Association website has a really good kind of library of articles, and there's some on valuation and valuation of pre-revenue companies, and I think they're really good. They're, like a lot of this stuff, they're a little dry, but sometimes you kind of read through, and I'll skip past some of the math sometimes, but they're useful.
Great, thank you.
Yeah, so I've got kind of term sheet control provisions. I'm actually going to back up just to this one slide. Board and governance, those are going to be issues that will be addressed in every term sheet, and those are really, really, really critical provisions. You want to look at, there's going to be appointment rights, probably. Somebody might have the right to appoint. Somebody, certain folks might be elected by a vote of only a certain percentage of the preferred shares. Certain might be elected by only the commons. Certain might be elected by the vote, the preferreds and the commons voting together as a class. So regardless of how that board is put together, you need to pay really close attention to that, because that's the folks that are going to be running the company and making decisions with you. So board governance is huge. Yes?
Chris, do you have any resources for where people can learn how a board works?
Let's see. Yes, and I've sent some to some people, some clients, so I can come up with something. I could just remind me, maybe send me an email afterwards. But there's some really dry stuff, like the American Bar Association's Corporate Directors Guidebook. And it goes on and on, but it talks about important stuff: fiduciary duties, self-dealing, corporate opportunities, all that kind of stuff. What's harder to find is, gosh, I've never had my first board meeting, and I've always been a board of 1, and now I've got a board of 3 or 5. And how do I do that? What do I do? What requires a board resolution? What doesn't? There's a lot of science and you kind of know for sure, you know, when you approve your bank loan documents. Okay, I should have board approval on that. Well, if I enter into this $200 a month contract, should I get board approval for that? But I can get you some guidance on that. Yeah. So board is kind of the first part of the term sheet on control. Now the stuff that I've got on control in term sheets, this is pretty dry stuff. So I'll try and make it interesting, because it's very important. but it does get pretty technical, which is actually part of why, if you've never looked at the National Venture Capital Association also, there's a number of sites that have good form documents, but the National Venture Capital Association and some others have a form term sheet. What I like about that, and I've got it up here with me, is because that's at least one group's view of what is market. Now remember what group it is, the National Venture Capital Association. So these are the VCs saying this is what's market. Well, it's kind of like if you look at construction documents, how the general contractors versus the property owners look at what's market can be different. But the first item we have on here is the preferred shareholder protective provisions. So these are provisions that will affect how you run your company, what decisions you can make, and what decisions have to be made in combination with others. So these are approval, generally speaking, approval of a percentage of the preferred class is required in order to take certain, what I'll call fundamental transactions. And I can give you an example of those: liquidating or dissolving or winding up the company, amending or repealing the articles of incorporation or bylaws, creating new classes of securities, purchasing or redeeming securities, the kind of stuff that if you think about, okay, that's really important company stuff that affects the cap table. Later on, I'm going to get into more of the protected provisions that are really board approval issues. Those are more operational in nature, but you'll find a term sheet from an institutional investor will generally have both. So these are more fundamental transactions. And you want to look at that list, and just because I have a list for the National Venture Capital Association doesn't necessarily mean that's the list, but I would tell you, generally speaking, the list on that form is a reasonable list. It's the kind of things that if you thought, well, somebody institutionally wrote me a big check, and what should they have a say in before I do things that would change their rights? Yeah, they probably ought to have a say in these types of things. So consider the list, consider the voting thresholds as well. If you have one person in your Series A round, sorry for all the pauses, I'm trying to make it like practical. If you have one investor in your Series A round that invested $1 million, there's no threshold that matters. Either they're going to approve it or they're not. But so you know, if you want to amend your articles, and that's one of the protected provisions, they have to say yes or you can't do it. Now, if you raised $1 million in your Series A round and you raised it in 10 $100,000 increments or checks, well, then the percentage approval requirement at this level is important. If it's a majority, well, then you need to get 6 of those 10 investors to approve, and then you can amend your articles. So you do want to think through that. Amending the articles is a good example of one that is a very reasonable one for your institutional investors to have an approval right. Blocking versus affirmative rights is actually a little bit more important on the director side. These sorts of special protective provisions should almost always be what I'm going to call blocking rights, meaning the company cannot do this unless this group or person approves it. That's very different than something saying if this group or person wants to do something, they can make it happen. It's very different. The minimum ownership requirement thing, I guess when I started practicing in this area, I thought this issue actually surprised me how it usually comes out. And my point is, if I come into it, if a fund comes in at a Series A level, a preferred stock, and they own 30% of the company, 40% of the company, it seems to me it makes sense for them to have a high number of protective provisions. But if over time or somehow they've been diluted or they've sold or whatever, to where instead of owning 40%, they own 10%, should they still have those same rights? You will find the Series A folks, and I wear both hats, right? Depending on who I'm representing in a transaction, I might explain to you how reasonable or unreasonable the same provision is. If they're dropped down to say 10%, does it make sense? If they're dropped down to 1%, you can take these extreme examples. That's usually a negotiating point. Next item. Management and information rights. Okay, so major investors, some of them, if they're funds, they really need, in order to have a qualification as a venture fund, they actually have to have a management rights letter. But more important, they should have, I think in fairness, it makes sense for a larger or institutional type investor to receive a high level of information and be informed on the company as a matter of right. We've already talked about how it's good practice to keep your investors informed, but typically speaking, the term sheet will include things that it will include information rights that these larger investors will want. Financial statements almost always would be in here. That may be just an annual financial, it may be an annual audited financial, it may be quarterly financials, or even monthly, which you'd always want to push back probably on monthly, but they want to be informed. Oftentimes, the annual budget, they want to see what the annual budget looks like. This is just really an information right. They're not generally speaking, we might get to the director level where they'd have an approval right on that. But you want to carefully consider that list. And I haven't looked to see what the Venture Capital Association has to say on management information rights here. It's going to be pretty consistent with what I've got there. Is there anything else that this one would have operating budget? It would have kind of a reconciliation at the end of the quarter to see how that's all played out. Annual, quarterly, and then in brackets monthly financial statements, tax returns. Consider the list. Consider is it reasonable or unreasonable. Don't set yourself up, if you've got a timeline that it takes for you at the end of a reporting period to kind of get these things together, you don't want to set this up so that you can't meet that timeline. Otherwise, my general advice to companies who are taking on institutional money is, as long as these are reasonable and not getting in your way, it's reasonable for those larger Series A folks to request these rights. Now this is preferred director approval. So this is different than the preferred stockholders having to vote on what I called earlier fundamental transactions. These will be more operating type transactions. And again, you want to consider, are these blocking or affirmative rights? It doesn't make sense for them to be affirmative rights where, let's assume you have a 5-person board and one or possibly two preferred directors. So if you need to get to, if your normal view of the world is directors operate by majority, right? So 3 out of 5 ought to be able to approve everything. Stop and take a step back and look at these protective provisions, because they will say that the company cannot do these more operational type things without the approval of the preferred director. And so you want to look at that list, and that is a list where I will tell you that institutional investors, particularly, some of them will really expand that list. I saw one recently that said needed the preferred director's approval for any expense. Honestly, any expense.
Wow.
Well, how does that work? You know, I mean, that's really subbing in that director for the CFO, the CEO. You know, it doesn't make any sense. So something like that just doesn't work. Again, we've got the same minimum ownership requirement kind of issue. Do they maintain a board seat when they came in at 35% having a board seat? Maybe even if they were 49%, maybe they have 2 of 5 board seats. Probably makes sense. If instead of 49% they drop to 3%, should they still have those board seats? Probably not, and those board seats are probably going to cause you some difficulty or renegotiation on down the line if you're still raising money. The types of issues that the National Venture Capital Association would say are reasonable ones for the preferred director to have to approve. Loans or advances to affiliates of the company, which is kind of a way of saying, we don't want you to form another company that we're not on the board of and start funneling things out that direction. Make any loan or advance to any employee or director. Makes sense. Guarantee indebtedness except for trade accounts. Guarantees to bank debt, that makes sense. I think they would have a vote on that. Incur aggregate indebtedness in excess of blank. So if you're a small company and the board wants to, let's say 3 of the 5 want to go get an operating line of $1 million. I could argue either side of that actually, but if I'm the institutional fund, I probably want to have approval right on that. Now, you would hope that your institutional investor and you are aligned. This gets back, you've heard a lot today about the importance of having the right investors and the right motivations and people you can get along with. You can have 5 people in a boardroom who reach different conclusions about whether $1 million line is the right thing to do. And if one of them has a veto right, you're gonna have to persuade that person. So you're gonna hope that you have good chemistry there, but that is a provision that's pretty standard that they would have that approval right. Oh, let's see, there's a few more on here. Hire, fire, or change the compensation of executive officers. Sell or license any material asset or technology of the company. So you can see these are more operational in nature. But you have to think about those, and as I say, sometimes that list is like this, and I've seen term sheets where that list is almost a whole page, and you don't want to be shy about saying, wait a minute, this one just doesn't make any sense. Rights of first refusal and co-sale. These are a kind of standard documents. I told you the National Venture Capital Association, some of these others have form documents that you can look at. That is a form document in NVCA called the right of first refusal and co-sale agreement. What it typically will say is it's going to benefit the institutional investors or the larger investors and say, if anybody else wants to sell, we get a right of first refusal to buy those. It typically is not going to benefit all investors. It typically is not going to burden all shares. So they want that right with respect to other people selling, but they probably don't want to agree to that right with respect to common selling. Or they don't want to incur that burden on their own. Also co-sale, which is also essentially tag-along, if you've heard of tag-along. That would be the right of, if a certain percentage of people are selling, or certain people are selling their shares, others would get a contractual right to tag along on that sale. They're going to benefit themselves with that sort of thing. They're not going to necessarily benefit everyone with that thing. Drag along. Drag along is the flip side of tag along, and if you think about drag along, you think about if a buyer wants to buy 100% of a company, want to buy the stock of the company, but they don't want to do the deal if they can only get 91%. The drag along provisions will say, in a nutshell, in a lot more words, because that's all lawyers write, that if a certain percentage, and that percentage might move a little bit, but it'll at least be a majority. If a certain percentage of the shareholders want to agree to such a transaction, a sale of the stock, then you will have to vote your shares in favor of that, and you will have to participate in that transaction and be dragged along. It's a reasonable provision, but you do want to be aware of it. Right to participate in future rounds. This one doesn't cause me heartburn one way or the other. It can be impactful, but you don't know until you get there. And that is really that these investors, if you're going to raise additional capital, they get the right to participate on the same terms as the other capital. Where that can be, it's reasonable. It's not like a non-dilution right. So we're not saying there that they came in at 40% and we raise additional capital and they still get kind of grossed up to 40%. That's the one that you just say no. This is more of what you call preemptive rights. So they're saying, well, if you're going to raise additional capital and I'm going to be diluted, I get to write a check, same check, pro rata as anybody else coming in, to maintain my ownership. It can be impactful, as I said. It's usually not one you're going to win the fight on. But if later on, if somebody else wants to take more and not to honor that provision, it can be a negotiation. Then I put kind of under this category sort of all the rest. All the rest here is pretty important. So these kind of fell under control on our outline. I'm not entirely sure they're control issues, but let's just talk about them. When investors are coming in, sophisticated investors, and maybe some less sophisticated, but one of the things they're going to reasonably expect, and you as the company want to have anyway, is they want to make sure that the intellectual property of the company is the company's. The company owns it through assignments of inventions from its employees, including founders. A lot of times founders form a company and they've filed a patent in their own name and they don't think much of it because the company is theirs, it's important to them, and they feel like it's the company's patent. Well, it's not the company's patent until it's assigned over. Similarly, when you've got employees that are working for technology companies or others and they're coming up with great ideas all the time, the investors will want to see, and the company will want to see, that that intellectual property is owned by the company. So you'll want to see that that's assigned and protected. Confidentiality and restrictive covenants, similar issue. Employees, particularly including founders and key employees, normally speaking, institutional investors or sophisticated investors will want to see that that everyone working with the company has a confidentiality agreement, so they're not out there blabbing about the cool stuff the company's got. And restrictive covenants, which might mean non-competes, might mean non-solicitations, might mean non-disparagements, which is just, I won't say bad things about the company later on. If you don't get those at the front end, and you wait till the back end when something's gone badly, or even when something hasn't gone badly, but somebody's getting ready to leave, you say, hey, that's great, but before you leave, can we get a non-compete? Good luck, you just won't. So you want to get those early. I do know a lot of folks who say, man, you know, I don't like them, they're not worth the paper they're written on, hear that a lot. Well, we would never enforce those anyway. All of those reasons don't ring true to me as a lawyer, because A, they have value even if you don't enforce them. As long as you don't tell the whole world, you would never enforce them. So they kind of prevent people from doing bad things. B is your investors will care about these, and C, they are enforceable as long as they're reasonable. And we can talk for hours about what the definition of reasonableness is, but they are important, very important. And they're hard to get if you haven't gotten them at the front end, and the reason you need them is because somebody has $1 million check they want to write, but they won't write it until you get those. Because you either don't get them or you pay for them, either which is very good, or you don't get the check. Employment agreements. That's again, a really key and gets into a strange dynamic when you are negotiating and bringing in outside capital. If you're the founder and you're an at-will employee, and so you've always cared the most about the company more than anything else you're doing right now from a business standpoint. Now you look at the balance of power on the board and stuff, and you kind of, if you don't think about it, you should, because wow, I could get out of the job. You know, what does that mean? Well, should I? And you're wearing a different hat now. Now you're negotiating on behalf of yourself, and it also gets weird from the lawyer's ethical perspective, because this founder who's always been there, yes, the company is their client, but the client is that guy or that woman. You know, that is the company. All of a sudden, that's not the company anymore. But that does become an important issue. You will find different institutional investors are more or less willing to give written employment agreements. Some just say no. Some will. There's some very standard provisions that you will see in those and I won't get deep into those, but termination for cause versus termination without cause. Maybe one place you should get some severance, maybe one place you should. Should the company have the right to redeem or require a sellback of shares if that person leaves? All those things kind of come into play so the founder / CEO at that point is now kind of looking out for number one. Nothing wrong with that. It just becomes a negotiation. So I did not look at the clock. I have no idea how we're doing on time, but I think we've got a few minutes yet.
We're doing great.
Yeah. Questions about any of this control stuff? Yeah, John.
Are there any areas of the law that are kind of shifting sands on terms, types, I guess employment law comes to mind from a number of years ago as to how broadly those can be enforced?
Employment and restrictive covenants is shifting, and it is shifting to narrow. So these ridiculously overbroad, after you leave us, you can never do anything anywhere in the universe, no matter what it is. Not enforceable. Typically speaking, you're talking about probably a year or 2 years, at least under Iowa law. Maybe you can go a little further. These are different, by the way, if somebody's like selling a company versus an employee, even a key employee. 1 or 2 years, and properly tailored in terms of scope, what can they, can't they do, where can they, can't they do it, it's probably enforceable. Non-solicitation of customers and employees, probably enforceable. That's a more protected, kind of identified sort of asset and risk. The other provisions, what I would say, are less changing from a legal standpoint, but they're always kind of changing as to what's market and what's market here. In fact, there's even services. We've got a service that we use for a number of legal areas called Practical Law. And Practical Law is a subscription-based product that has a function on there called What's Market. And it's always interesting because I've done lots of negotiations with attorneys on the coast where either they're wanting something or we're wanting not to give something, and they'll say, well, that's market, or what we want, they'll say, well, that's not market. That's relevant to a point. I'll sometimes respond, well, what's market? It's either market or not market, but I don't care. If you've got the ability to walk away from the money, if you've got the ability to say, it may not be market, but we're not going to accept it. Or it may be market where you are, but it's not market here. And there are provisions like that you will encounter. Those are shifting all the time. What else on control? Control is such a key issue because all of these other provisions that we talk about that can be unreasonable in their application and can be just fine. That 2 times preference we talked about earlier, I was going to mention when it came up. The balance of power and control on that one is really interesting because there's 2 times preference. And looking at a sale price on a particular deal, there's a whole bunch of people who aren't going to like that deal, and a few people are going to like it a lot. But the way the balance of power works out on the voting and the special protective provisions and all that, it can't get done by the people who have the 2 times unless they can get some of the other people to come to the table and approve. So that's when that renegotiation is going to come up. Sometimes there's a deal where somebody's ready to have an exit transaction, sell the company, but the buyer only wants to do the deal if they can get these key employees to come along. Well, what the documents say may be far less important than the practicalities of what's going on right then. And the people who are those key employees, maybe they never liked the deal they had on something. And I don't mean that they have bad motivations, it's just maybe this works out for them that now, I guess I'm more important to this deal than I thought. So control is really, really, really important. And conversation, anything that becomes a controlling issue or an expectation created at the time of the marriage, that you think you understand what everybody's shooting for, you won't always get them into a contractual form, but if you can, do it. Because if you thought, gosh, I thought we would never sell the company until we hit 100 million, at 100 million, I didn't mind, even a 3 times preference, didn't bother me at 100 million. But now if we're going to sell at 30 million, wait a minute, I just ended up on the short end of the stick on that. Okay, great. Oh, yes, Steve.
Chris, if I may add a resource, it didn't hit me earlier, otherwise I would have shared it. So as you were going through the term sheet elements and the various phrases, I'd gone through a venture deals course where over about a 3-week period, they addressed all of these elements of the term sheet, and at the end of the period, they had us go through a term sheet generator. It essentially encapsulates all of these elements and makes you think about the questions you would answer about your business through this generator. So it's about a 50-page question. So it's no BuzzFeed survey. It'll take time. It's not going to generate a term sheet that's, per Iowa law that you would submit here. But it will at least take us through the questions, and it's called WSGR Term Sheet Generator. WSGR is the name of the firm.
I know those guys.
But the way they did the work, it's funny, you go through that 50-page questionnaire and you end up with a 1.5-page term sheet. So it's almost a letdown, but it is, it's a clear-cut term sheet.
It's funny, I have to make one just sort of joke. Because that's a well-known venture law firm out from Silicon Valley, and they're involved in a deal right now. I was on the phone last night, and what market in terms of the cap on legal fees for a particular type of transaction was what was put in this term sheet we were talking about last night. And with no embarrassment or humility at all, they said that cap is like 1/4 of what we would ever do this deal for. So we're not saying we won't be in the deal, but can you, Brown, can you guys draft all these documents? Because we would never agree to that. So, interesting. I don't know that we will either, but it was.
So you incorporated an office in Palo Alto
Right,
after that?
exactly.
Just so we can start charging $800 an hour.
That's about staying in Iowa. All right, we're going to take a break until 3:15.